G'day YouTube and welcome back to ASX Portfolio. My name's Jonathan speaking. So today we're going to be talking about two really exciting things. One, historical volatility, and two, risk return measures. So we're going to be talking about 5 risk return measures. So we've got the Sharpe Ratio, Sortino Ratio, M2 Ratio, the Calmar Ratio, and we're talking about the concept of max drawdowns. So let's get straight into it. Just like the last couple of episodes, we're just going to make, you can just grab this from the website. So we're going to import the dependencies, date, time, pandas, data frame, NumPy, pandas data reader, Plotly, and make sure you initialize Plotly notebooks and pandas back end for pandas data frame as Plotly. So make subplots, make sure you import that from Plotly as well. We're going to get a couple of stocks here. So we've got CBA, NAB, STO, WPL, and we're grabbing the ASX 200, so the market index, and that's very important for the M2 ratio, as you'll see. We're indexing on the close prices for the data frame, and we're returning that data frame there. So let's get stuck into it. We're going to return the log returns. So remember, the way we're going to do that is get the close prices. So we're going to take the NP log of df.close, and we're going to divide that by df.close.shift1, and we will drop all of the NAs. So let's return that. Excellent. So from there, we're going to use standard deviation or sample standard deviation to get a gauge of volatility. So we'll call this daily standard deviation, and we're going to take those log returns. We're going to take the log returns, and we're going to get the standard deviation of those daily returns. So just .std. So we can return that, and that gives us the daily standard deviation. What we would like to do is actually get the annualized standard deviation. So we'll make a data frame, annualized vol, and what we're going to do, we're going to take that standard deviation and we're going to use the square root of time rule. So np.square root and 252 trading days within the year. So that gives us the annualized volatility, and I'll times that by 100 to get the percentage. So that's coming through nicely. Now, I think it's a great way to be able to visualize this in a histogram. So we're going to take the log returns, build up a histogram, and plot the annualized volatility next to it. So for this, we're going to use Plotly, our favorite tool. So we're going to make subplots, and we're going to go rows equals 2 and cols equal 2 for the 4 stocks that we have there. So for each, we're going to make traces. So trace 0 is going to be go.histogram. And for X, we're going to take the log returns, and we're going to have cba.ax, and we'll name that CBA. So we'll just do that for the other 3 stocks. So we'll just copy that there, make sure the traces are labeled separately. CBA, we're going to name this one NAB, we're going to name this one STO, and we're going to name the next one WPL. Awesome. So now that we have the traces, we actually need to append them to this graph. So let's go fig.append trace. And we're going to do this individually. So we've got trace 0, and that's coming in at location 1, 1. So this is in terms of rows and columns. The next one is going to be row 1, but column 2. And that's going to be trace 1. And then it's going to be the same thing for rows 2, making sure that we've got the correct indexing there. Cool. So at this point, we could go fig.show. Excellent. So now we want to take this plot and add some more information. So we're going to update the layout. So first thing we're going to do is we're going to stop that auto sizing. I really hate that in Jupyter Lab. So we just make that false. We'll call the width 600, and the height can also be 600. So now that we've got that defined, we'll get the title and we'll call it, every good graph has a good title, frequency of log returns, very individual. We've got the x-axes that we want to label, and how we want to label these x-axes is with this information for annualized volatility. So what we can say is go CBA annualized vol, and we're gonna put the string of NP round. So we're gonna round this information probably to 1 decimal place, gonna make sure it's a percentage, and we're just gonna index this annualized vol by the stock that of course we're referencing. So the first one is CBA, make sure the brackets are okay before copying that. Excellent. So x-axis 2, x-axis 3, x-axis 4, NAB, index NAB here, STO, make sure it's named correctly, WPL, WPL. Cool. Run that, tell us what we've done wrong. And while looking at this, I've forgotten to put title here. So within the dictionary, you actually need to specify that this is the title. Run that, and excellent, you get your plot. So that height's actually pretty vicious, make that 400. So we've got our frequency of log returns, we've got our annualized volatilities, and the different histograms. It's nice to be able to see that you can see the outliers that don't really look normal, and you get your annualized volatility here. Another useful way of visualizing volatility that I really like to implement is over time. So trailing volatility over time. So we're going to create a trading window. We'll call it trading days, so 60 will make it. So we're going to specify volatility, and we're going to reference this log returns. We're going to use pandas rolling, so rolling function. Our window will be this time period trading days that we've specified. We'll take the standard deviation just as we have before, and we'll multiply it by the square root of these trading days. So now that we've got this volatility, trailing volatility over these trading days, let's plot that to get better perspective of what it actually is. So we'll update that information, update layout with this auto sizing. Hate it when it auto sizes. Make that 300. So here you can get pretty good perspective of how these volatilities change over time. The historical volatility changes over time. As you can see, this would be really nice if you had the graph of the stock prices just above, and you can compare when volatility starts to kick in. So now that we've talked about historical volatility and estimating that with standard deviation or sample standard deviation, let's now move on to the different ratios that we can use to understand risk versus return, or return versus risk. So the first thing we're going to do is this Sharpe ratio. So the Sharpe ratio is essentially just the average return over time divided by the units of volatility over that time period. The return is also, it's with respect to the risk-free rate. So it has to be the return in excess of the risk-free rate. So let's say that we had a risk-free rate of 1% over a year. Remember, a year is 225 trading days, so we'll just divide by 252 there. So we will make the Sharpe ratio, and we're going to do this over time. So we're going to do a rolling window for this Sharpe ratio. Remember, you could do it over the entire period and get one number. We're gonna make a time series plot here. So log returns dot rolling, call the window trading days as we've specified as 60. We will calculate the mean from that. So remember, this is still a daily amount. We'll subtract the risk-free rate of that many days, and we're going to multiply through by the trading days. The reason we have to do that, because when we're dividing by a volatility data frame, we've specified this number of trading days going back to calculate the standard deviation. So you could change the trading days up there, but we'll just leave that for the time being. We'll plot this, we'll add that update layout information, just keep copying it as we come down. And you can see here we end up with something really cool. We end up with the Sharpe ratio over time, changing with this window of trading days. And that can be really helpful understanding how the mean's changing over time, understanding how the volatility is changing over time in just one simple graph. So you'll see a lot of people implement Sharpe ratio over a static time period. I find it very useful to look over a window, and you could have this updating every day or whatever time period you want to gauge what stocks you're interested in using these metrics. So moving on to the Sortino ratio. Sortino ratio is really interesting. So it similar to the Sharpe ratio. It's just the only difference is we're saying not all volatility is bad. We'd like upside volatility, but we want to limit downside volatility. So down moves we're going to take into consideration with this Sortino volatility. So the way we're going to do that, we'll call this Sortino vol. Instead of our volatility matrix line up here, I'll just copy and paste it so you can easily see the difference. So Sortino vol, here's our original volatility frame. The difference we're going to make here is that we're going to index this log returns by only the values that are less than 0. So we're going to take the volatility only over the values where the log returns are less than 0. To this rolling window now, we're going to end up with a lot of NAs, so NANs, so not a number values. So we need to add in this center equals true element and min periods, let's just say 10 days. So we'll now enter that, make sure it's okay, looks good. Now this Sortino ratio is just going to be the same thing as before. So let's copy the Sharpe ratio. So it's going to be the same as the Sharpe ratio, but instead of dividing by volatility, we're going to divide by this new Sortino ratio. So we'll just go equals on that. So to put that in perspective, let's take the Sortino vol first and we'll plot that over time. Plot that over time with the update layout. Whoop. Careful when you're copying and pasting. And you can see here that the Sortino volatility has a slightly different shape to the normal volatility here. And again, that's expected because we're only taking into consideration downside volatility. So now seeing how that's represented in the Sortino ratio, you can see that we end up with a completely different graph to the Sharpe ratio. So again, it's nice to see these values over time, which is what we're doing, a little bit unique compared to what you see on most blogs and things like that. So the M2 ratio. So this is a pretty easy one to explain. We're going to take a benchmark volatility and we're going to call that the ASX 200, so the market index, and we're going to use that volatility to benchmark the adjusted risk of all these portfolios. Essentially, we're just going to back out the return from the calculated Sharpe ratios that we have for all the individual stocks. So let's get stuck in. M2 ratio. We need to find an empty pandas data frame. So we just go pd.dataframe and our benchmark vol is going to be equal to that volatility data frame we had before, and it'll be indexed to the AXJO. Excellent. So now for column in, we want the log returns dot columns. So for all the columns in log returns, if that column is not equal to, our benchmark, because we don't want to do the benchmark against the benchmark. That would be funny. We're going to define this M2 ratio indexed by the column, so the stocks, by the Sharpe ratio column, and we're going to multiply that whole column by the benchmark vol. Excellent. So for the benchmark vol, we're going to multiply that by the Sharpe ratio. Remember, the Sharpe ratio is the adjusted return with respect to the risk-free rate divided by the volatility of that stock. So we multiply by the volatility, back that out to get the adjusted volatility of the benchmark, and we need to divide that by the trading days, and we're going to subtract, we subtracted the risk-free rate, now we're going to add it back to get the actual returns, this adjusted return, and we can multiply by trading days to put it in perspective of our time frame. Log returns not defined. It's because we called it log returns. Excellent. So now that that's been updated, let's plot that out. Plot, copying and pasting again, that update layout. And you can see here our percentage changes over time now of all our individual stocks with respect to the market index volatility. So it's a very interesting ratio to be able to compare this to any benchmark you so wish. So that's the M2 ratio. Moving on to something a little bit more specific as a metric is the max drawdown. So max drawdowns is going to be the cumulative return profile over time. What is the maximum drawdown from the peak of our investment down to the bottom? So what is that percentage max drawdown over our time horizon? So for this, we're going to define a function. We're going to call it max drawdown. And this will take in a return series. So this return series is going to calculate, firstly, the cumulative returns. The way we can do that is we're going to take, instead of using the log returns here, we're actually going to use the simple returns. So we'll just get the percent changes in a second. But when we've got them, we'll add 1 to them and we'll go the dot of the cumulative product. So we've got the cumulative returns over time now. We're going to take the peak as being this cumulative returns, use this function called expanding, and we'll make the min periods equal to 1, and we'll say max. So essentially what I'm saying here, find the absolute peak of this cumulative return series. That's all it is. We're then going to specify this thing called the drawdown, which is going to be the cumulative returns divided by the peak minus 1. Now, the way that I've defined this here, divided by the peak, we actually want to minimize what this is so that we can find the maximum drawdown over this time period. Excellent. So when this is a minimum, it'll be the maximum of the drawdown. So as I said, we need to define a new returns function. So we'll just go df.close and take the percentage changes and drop NaN. We'll take the max drawdowns, take the returns, and we're going to use the apply function to apply this function. We need to specify the axes which we're applying this on, and axes equals 0 for the columns. So now that we've done that, we'll print out max drawdowns and get it as a percentage by timesing it by 100. Tell us what we've done wrong. Percentage changes, so it's percent change, sorry, not changes. So as you can see here, we've got the percentage max drawdowns over that given period of time. Now to help put that in perspective, we're going to calculate this thing called the Calmar Ratio. Now, the Calmar Ratio uses these percentages, or the absolute percentages, and puts it in context of the return of these stocks. So instead of getting a return divided by a volatility unit, we're using the volatility unit as being this max drawdowns. So let's see what this looks like. So these things called Calmars are going to be NP exponential. So we're just backing out the log returns dot mean over time, 252 trading days. So we're just getting the absolute return over 252 trading days for the mean, and we're going to take the absolute max drawdowns number. So now that we've got that, we can just go calmars.plot.bar update layout. Where's our last update layout? There it is. And that's really interesting. You can see here that the ASX 200, because it had the smallest maximum drawdown over that period, but it has quite a modest return, has yielded the largest Calmar ratio, putting in perspective the returns versus risk metric. So a whole bunch of different return versus risk metrics we've looked at today. We've looked at historical volatility and how to calculate that using sample standard deviation. So hopefully you got a lot of value out of it. Please subscribe to the channel if you would like to find more content like this. We're going to keep building in these series and get more and more complex, more in depth in terms of finance with Python. So thank you very much for listening, and see you next time.